On the financial front, this chart neatly captures what I believe is the main explanation for why we had a financial crisis. As you can see, up until the early 1980s, recessions were fairly frequent. But starting in the early 1980s, it became very infrequent and very mild. Inflation dropped down into single digits and stayed there. Unemployment dropped down into single digits. And even though we did have financial events or chaos like the 1987 stock market crash, they never seemed to disturb the overall economy. And this became known as the Great Moderation. And central bankers like Ben Bernanke said, well, this is because we as central bankers have gotten so good at our jobs. And frankly, I believe them as well. But what happens when the economy seems more safe and stable and you think that there's going to be fewer recessions? Well, you borrow more money to buy things like houses. Because after all, the price of your house isn't going to collapse in another depression because there won't be another depression. And if you're a company or a bank, you don't hold less cash in reserve to deal with a rainy day because there aren't going to be as many rainy days. Yet it was those very fragilities which set up the economy for the crisis that happened. And it's not like this was all about deregulating the banks, which is one of the narratives you hear nowadays. It really wasn't, because even after Paul Volcker and Alan Greenspan saved the banking system from all the problems that they had in the early 1980s, from loans to less developed countries and so forth, they wanted to fix them. They wanted to they regulated them better. They required them to hold more capital. Capital is basically that cushion of shareholders' equity which absorbs losses if some of the loans go bad. So from the first chart, you can see here that this is the loss of capital that occurred from the crises of the early 1980s involving Mexican loans and loans to Texas real estate. But from that point on, shareholder capital became steadily more safe, and the banks therefore should have been safer. But look what happened. As banks became safer, well, equity capital actually makes lending less profitable. All these regulations made banking less profitable. And so they took some of their risks, they moved them elsewhere. If they made a mortgage, they didn't keep that mortgage. They bundled it with other mortgages, and they turned that into a security, and they sold that to a pension fund or a foreign central bank. And so you can see what happened. As banking became safer, it became less important. A lot of their lending and the deposit gathering that they used to do, and that still goes on in countries like Canada, moved to other companies that became known as shadow banks, which weren't as regulated as regular banks, as tightly regulated as regular banks. And that was supposed to be okay, because in our history, crises were always about the banks failing. Go all the way back to 1907, that financial panic. Every major crisis was about banks failing. And so the theory was, if we can get the banks to take less risk, we have prevented serious crises from happening again. If it goes off into shadow banks, companies like Bear Stearns and Lehman Brothers or Fannie Mae or these, esoteric off-balance sheet vehicles, that's okay. Okay, those are sophisticated investors. If they lose their money, it doesn't harm the overall economy. But what we now know is that those shadow banks became so large and so fragile themselves that they were more important than the banks. And when there were runs on those shadow banks, that was the ingredients of which a serious financial crisis was made.